Hey, Bowtie Nation, Joseph Hogue here with you. Another great live stream, Beer Money Sunday. I've actually doing coffee this today. Long night last night, so wanted to stay sober for you and get something out here because I think this is going to be an extremely important video for you. A lot of investors out there. See a lot of great members of the Bowtie Nation. There's citizens of the Bowtie Nation. They're in the chat. Let me know where you're coming from. Palm Bay, Florida, Sacramento. I see Belgium and England in the house there. Germany, thank you for being here. I know it's not always the easiest time around the globe to be here, but I love doing these because it's just a great way to connect with you out there. Answer some questions and talk about a topic for the week. And this week, it is a topic. It is the topic that we need to be talking about. Whether we're in a stock market crash, how far stocks could go from here, and what you can do about it. And to be clear here, as I've stated, as I said last Sunday, as I said in a couple of our shorts videos this week, we are not in a stock market crash, folks. I'm sorry, but even though, it might feel like it in your portfolio, we're not in a stock market crash. And I'm going to show you, where the indexes are and where stocks are in a little bit. I'm going to explain why this is that we're not in a stock market crash, but you could be feeling a little bit of pain out there as investors and why it might seem like a stock market crash. I'll explain why stocks are falling and how much further it could go. And then give you some ideas for what you can do as far as strategy. What price points you can look for in the general markets there for the indexes as well as individual stocks. Okay, so we'll start off with what stock levels or what price levels in the S&P 500, the Nasdaq, and the Dow that I'm looking for to kind of gradually get back into stocks and put more money to work, as well as how to look at some of those stocks like Apple, Tesla. We'll cover Salesforce and PayPal, some of the hot stocks, the tech stocks, and stuff like that, for how much further they could go down and what price points I'm looking at to get started there. So again, thank you for being here. I'll personally invite you to join to get the Bowtie Daily or the Daily Bowtie. It's our daily market newsletter. It goes out 9 o'clock every night before the market opens. It's just a way to get all the strategies, the news, the important news that you need to know, and the trends out there, and give you time to plan your next day of trading. And then, after all that, we'll get to a Q&A. So I put a link to the Daily Bowtie up there in the live chat, pinned it there. I'll pin it in the comments below as well. So make sure you check that out. It's totally free. I'll never ask you to pay for receiving those. Just something I've been wanting to do for a while there for all you out there in the community. Again, thank you. Thank you for being here. I see Trinidad and Tobago, Hershey, Pennsylvania. Great to see everyone here. Quick housekeeping, a couple of videos last week. We did one of our big cryptocurrency videos on Friday. Going to start doing more of these. I've just moved a lot of my money over from Coinbase, which I was using, to BlockFi to earn that extra interest rate. You earn up to 8.6% interest on your crypto assets there on BlockFi. So I'm using that now, as well as some great things coming for that. They're coming out with the first ever credit card where you can earn 1.5% on your cryptocurrencies. So that's, or on your purchases on that credit card. So that's going to be real interesting. But I actually did a Bitcoin valuation analysis, and I'm going to follow it up with a valuation for 7 other cryptocurrencies next Friday. That's going to be, and I think it really puts kind of a long-term picture on these investments. So make sure you check that one out and stay tuned for Friday's video on those other assets. This week, tomorrow, we've got our March picks for our stock card Bowtie Nation 2021 Bowtie Nation portfolio coming. Going to do three stocks that I've added to the portfolio for March. Actually already added them last week in that reopening trade. So huge theme right now. The reopening stocks, the cruise lines, the airlines, the malls, all the companies, all the businesses that should benefit as the country or as the world really reopens, and what to look for. And I think you're going to be surprised by the 3 that I picked, and actually that a couple of segments are left out there. I'm not in airlines and I'm not in the cruise lines in those, and I'm going to explain why that is in tomorrow's video. And then Wednesday, we've got a great penny stocks video coming to you with some of these long-term themes that we've been covering in the ARK Invest Big Ideas series. But I want to get to our topic today because This is just crazy. What's happening in the market, and I think even worse is what it's doing to a lot of people's portfolio, even if it's not a stock market crash. Okay, so if we look at this, the S&P 500, it's down just 2.7% from its peak. A few weeks ago, actually. It's not that long ago. The Nasdaq is down a little bit more, 9%. It actually hit correction territory, which is 10%, this week, but it closed 9% down from its peak. So the market is not in a crash. Okay, we generally define a stock market crash by prices in the index in the stock market. So that broader S&P 500 index of 20% below recent peaks, right? And it's not even close to there yet. A stock market correction, is anytime stocks come 10% down from their peak. So we've seen that in the Nasdaq, that tech-heavy Nasdaq, but we really don't see it in stocks in general. Okay, but the problem is a lot of investors, and this is where I think a lot of investors are getting kind of confused when I say there's not a stock market crash. I don't expect a stock market crash to come as we're plowing, another $1.9 trillion into the economy, plus households have saved up $2.5 trillion over the last year. That's all that pent up demand they're getting ready to spend. The problem is a lot of investors are looking at from their own portfolio, and I'm going to try saying this as politely as possible without offending anybody, but your stocks are not the market. Okay, your stocks, the stocks that you're holding in your portfolio, unless you're holding a diversified portfolio of different sectors, different assets, the S&P 500 index, your stocks aren't the market. Okay, I know a lot of investors out there that have rushed into these high growth, these tech names over the last year because it worked. Okay, and honestly, I can't blame the investors out there, because I see a lot of YouTube channels where it's basically it's like chart porn, right? The YouTuber will bring up a chart of a stock and basically just mouse up and down that chart, saying, "Oh, what a great chart this is! It's gone up 600% over the last year. I love this stock. It's going to be huge." And that's basically the entire analysis on this stock. And it's worked. Over the last year, people have made big money by chasing those momentum stocks, chasing those tech stocks higher, and a lot of people are exclusively invested in those stocks. Okay, and problem is that a lot of investors that have been doing this, they don't understand that momentum investing strategy. Okay, the momentum investing strategy, you're chasing a stock, as it goes up and enjoying those returns. But that momentum works on the downside as well. And I have first-hand knowledge of this. Back in 2006, I was actually, I was big into the momentum trade, chasing a lot of these stocks just before the crash, obviously. So stocks were doing very well. And I actually went down to Louisiana to visit my mom. She had moved down there that year to help with the cleanup efforts for Katrina. And the market fell 5% in 2 weeks, and the biggest sell-off was right around the couple of days when I took my vacation. Right, I took it. I think I left Wednesday night, so I was out on Thursday and Friday of the market, and I lost $18,000. Over those few days. And it sucked, but I knew that was the market game. I had already studied the markets enough. I've been working in equity analysis for a little while, and I know that, okay, when you're in momentum investing, you have to have a strategy. You have to be watching the market for when that shift comes to the narrative, to the story, okay, and when those stocks aren't going to work anymore, okay? And what we're going to talk about today, a lot of that is why those stocks aren't working anymore, those tech stocks, those growth stocks, and how to shift your strategy. It's something we've been talking about on the channel and in the daily bow tie for a few months now, that rotation from growth stocks, from tech stocks, to energy, to cyclicals, to reflation trades, sectors like that. And I know a few of you are waiting for me to kind of list those out, so I want to do that real quick before I forget, because I don't have it in my notes here. But so I want to go through kind of what I'm talking about for different sectors here, and we're going to go to the sector tracker. Again, great tool, great resource that I use. I use it for the daily bow tie whenever I do the daily sectors, as well as just my own research and analysis. But you go to here to sectorspider.com. That's the and you'll see the sector tracker under tools here, right? And now that's going to give you all 11 sectors of the S&P 500, all 11 sectors of the economy, and how they did that day, over the last week, month, all the way up to 5 years. And it's just a great way to see kind of some of the rotations that are happening. Okay, and obviously, Friday was an up day for everyone, but you pull out here a little bit more to maybe 1 year or year to date, and you see this happening. And this is what we talked about back in October, back in November, when we were planning this rotation shift in stocks that I saw coming as rates were coming up a little bit, and as we were looking at the economic recovery and that kind of thing. And what we saw was, so growth stocks. Growth stocks are any stocks or any sectors where the stocks and the companies typically see faster earnings growth than the market average. Okay, so obviously, you're going to see things like communication services, which, although it does include those slower growth telecom companies, it also includes most of the internet names. Okay, so most of that communication services sector is dominated by those internet names. Okay, internet content, social media, things like that. So that's in the growth stocks. You've also got technology, obviously, those fast-growing tech companies. And both of these did really well last year. Okay, obviously, and I'll explain why that happened and what changed here in a bit. But so your growth stocks, your growth sectors are typically technology, communication services, things like that. Your reflation trade. Now, you're going to hear a lot lately and going forward, you're going to hear a lot about the reflation trade, right? And these are just stocks or companies that tend to do well when inflation is coming up a little bit more, right? It doesn't mean runaway inflation or anything, but when inflation is growing, when the economy is growing, when asset prices and businesses are growing. So think of commodities. Think energy. Think of things that do well with a little bit higher inflation. Okay, so here you're going to have things like energy. Okay, energy over this just year to date. Okay, so for the first 2 months of the year, energy is up almost 40%. Right, the stocks in the energy sector, and we've really benefited from it. I think so. Diamondback Energy, one of the first stocks we added to our 2021 Bowtie Nation portfolio, is now up 180% since November. Devon Energy, one of the top 3 stocks of Friday, is up. I think that one's up 85%, something like that. The financials is another one that's doing really well lately, and it's because of the interest rate environment and that reflation trade. Okay, as interest rates rise, obviously banks they make more money on their loans. What we're seeing right now is because the Federal Reserve is holding those near-term rates down to zero, right? Any kind of very short-term interest rates, the money that you make on your deposits in a savings account is zero, okay? And the Fed is just with all its might holding that down, trying to push investors, trying to push people into longer-term assets and prop up asset prices, prop up the economy. Well, what happens obviously is when longer term rates rise, as they've been doing, then the banks make more money on their loans. The banks are now able to loan out on a 15 or a 30-year loan. Average 30-year mortgage went up to about little over 3% just this last week for the first time in about a year. So if they're making 3% or more on their loans, paying next to nothing on your savings account, then obviously the banks are doing much better. So that's part of the reason why financials are doing well. Other parts of the reflation trade there is materials. Obviously, a lot of materials companies, they dig this stuff out of the ground, the copper, the metals, the precious metals, things like that. And as inflation goes up, as the value of the dollar goes down, these commodities hold their value, right? Because gold holds its value against inflation, against the depreciation in the dollar. So those are going to be your reflation trade sectors, okay? Materials, financials, energy, and combine that with the cyclicals, okay? And cyclicals are just stock sectors that tend to do well as the economy is rebounding, okay? And so to that we'll add industrials. That's a good one for a cyclicals trade, as well as I wouldn't necessarily say consumer. I'd say probably just really industrials as another cyclicals trade. Energy, financials, and materials are also included in that cyclicals sectors once in a while, but I like to call it reflation trade here because that's really what the market is talking about right now. A couple of these other sectors that you want to think about is utilities, real estate, and consumer staples. All three of those are very interest rate sensitive sectors. Okay. So, and why that is because the cash flows on these tend to be very stable and fairly low growth, right? And the returns on these sectors, on investments in these sectors, tend to be, mostly from that cash flow from the dividend, right? That they're paying out. You're not gonna get rich on utility stocks or real estate investment trusts, REITs, or consumer staples, that Procter and Gamble, the Kellogg's, right? The stock prices aren't booming to the moon, but you get a very nice dividend that is very stable, and that cash flow is pretty much secure. Well, what happens here is because of that security and that low growth, these tend to be kind of alternatives to bond investments and other interest rate and yielding investments. Okay, so what happens is why these are so yield sensitive is because when the interest rate goes up, then these look a little less competitive, right? Less like something that you would want to invest in against higher interest rates that you can get somewhere else, maybe in bonds, in safer bonds. So the reason why these three sectors have been lagging, utilities, real estate, and consumer staples, is because yes, as that interest rate goes up, those lag. Okay, and then you've got a couple of other ones here. The consumer discretionaries tends to be a little bit more cyclical, but the problem we're having here is with the interest rates, and something we're going to talk about right now, why those are underperforming as interest rates go up. Okay, so that's really what I'm talking about when I talk about sectors like the growth sectors, the momentum sectors, the reflation sectors, the cyclical sectors, the interest rate sensitive sectors. That's really what I'm talking about. And then of course the stocks within those are very much a function. How those do are very much a function of the economics behind all this. So now I want to get into how yields are affecting stock prices, because this is going to be the theme of the year. Okay, it's been the theme over the last 2 months. I think it's going to be the major theme over this year is interest rates, why they're rising, what they're doing to stock prices, and why this is really causing a lot of pain in a lot of your portfolios. So I want to cover that and show you why this is happening. So what happens here? Okay, so basically, if you've been living under a rock, I guess the interest rates on that longer term, the longer term interest rates, right? Because like I said, the Fed is just pushing everything it can to keep those short term rates down, right? The 2-month treasuries, things like that. It's holding those rates down, but it can't quite do as much on the long-term rates, right? It buys a lot of the shorter-term bonds and stuff like that to press those short-term rates, but it's not doing quite as much on the long-term rates and letting those rise. Well, the 10-year Treasury, which is really the benchmark for all the rates that the market watches, right? The 10-year Treasury bond, the rate on that has gone from 0.95%, right, just under a percent to start the year, up to it hit 1.6% this last week, and it's right around 1.55% this week, or to close out Friday. So that's pretty much a 50% move in interest rates, which is huge in interest rate terms. Okay, it's from 1% to 1.5%. And the problem here is something called is really how you value stocks. Okay, so we'll share this. And this is probably a little bit hard to read here, and definitely more math than we want to get into. But when you value a stock, right, stock's value is the all the future cash flows that stock is going to produce, that company is going to produce, right? And of course the goal of an investor is to kind of estimate out these cash flows, what you're going to get in terms of dividends and all that, out so many years in the future, and find what it's worth today, the present value. And that's called the discounted cash flow formula. Okay, so what you got here is the intrinsic value. The value of a stock is worth cash flow in year 1, cash flow in year 2, all the way out to however far you want to the terminal value of that stock, right? However far you want to measure this out. And when I was working as an analyst, I used to do maybe 5, 10 years, usually not quite so far out as 10 years, but 5 or 6 years, and then you'd put a terminal value on the end. And that's a big part of stock investing, of finding that intrinsic value and really pricing stocks for that. Well, what you've got here, you've got the cash flows on the top here divided by a discount rate, right? This interest rate, this I. And for each year, you discount those cash flows back because you're finding it's a future value. It's something you're going to get in the future, but you want to find the present value of that. You want to find what those dollars are worth today, and they're not worth as much as they will be in the future. Okay, because because of inflation and what you could be making on that money right now, right? So this discount rate is a way of saying, okay, this is future money, but I want to see what it's worth right now, what it's worth in today's dollars at a rate that I could get, on other investments, at kind of an opportunity cost rate. And there's different ways to calculate this discount rate for yourself. It's some investors just like using bond rates. What could I invest in a bond and be pretty safe? And so what do I want to discount these cash flows from a stock? Some use kind of a little bit higher opportunity costs or an equity risk premium, that kind of thing. But basically, we're just talking about what we're dividing these cash flows from to get the present value, a discount rate, and those bond yields, that 10-year Treasury is a big factor in that discount rate. Okay, obviously, if investors can get pretty much a risk-free rate of return on 10-year Treasuries on bonds, then why would they invest it in stocks? So as that interest rate goes up and pulls stock investors into bonds, into corporate bonds, into safer investments, things like that, then it's kind of a sucking effect out of those high risk stocks. Okay, but it also increases this discount rate. Okay, so what happens is, as you increase the bottom part of that formula. So let's just simple math here. If the future cash flow next year of an investment is $1, if you divide that by a 1 discount rate, right? 1 divided by 1 is 1. If you divide it by if you increase that discount rate though to 2, 1 divided by 2 is only 1/2. Okay, so what you're saying here is, as you increase that interest rate, as you increase the discount rate that you're discounting these future cash flows at, those future cash flows of that stock become worth less. Okay, so let me know if that's not clear, because it's very important to what we're talking about here and why these high PE stocks are getting hammered so much, while the market really isn't seeing quite the losses. So what's happening here with these very high PE stocks, with these stocks trading at 50 and 60 times their earnings, right? A lot of these are those growth stocks where investors are planning on that 10 years of super normal growth, right? Obviously Tesla is making money right now. They've got great cash flows right now, but the majority of that value is off 5-10 years into the future. Those huge cash flows that we're expecting from Tesla, from a lot of these stocks, Salesforce.com, from QuantumScape, from a lot of these EV stocks, that kind of thing. Their cash flows are way out in the future, which, just like we just looked at, if you want to find a present value for that, you have to discount them by that interest rate. And so as the years get further out that you're expecting that cash flow, the discount rate is higher, and you're discounting it more to the present value, because with each year that you're discounting out, it's you raise it to an exponent, right, of how many years that is, right? And so what we can look at here is really the effect that those interest rates falling has really had, and it's really amazing, how much interest rates have really played into these stock prices. Okay, this is a chart of the 10-year rate over the last 5 years. Okay, and you can see the 10-year rate, the yield on the 10-year Treasury peaked at about 3.2% in 2018. And even before the pandemic, the Fed was, the interest rates were coming down. The Fed was lowering rates and stuff, and it came down to all the way to 0.53% in October of 2019, or July of 2020, excuse me. Peaked in October 2019, came down to July 2020, came down to 0.5%. Okay, and consequently, this is exactly when you see the stock market booming. The stocks. Obviously, again, if we're using that discounted cash flows formula, and at first you're discounting all these cash flows in future years at 3.2%, right? You're discounting them back at 3.2%. Now, all of a sudden, over the course of not even a year, you're saying, you know what? I'm not discounting it at 3.2%. I'm only going to discount it at 0.5%. that has a huge force on on stocks, huge moment or force higher on stocks. It really just amplifies the present value of those future cash flows on those stocks, and that's exactly what we saw. We can see. So here's the PE ratio over the last 10 years, right? The price to earnings ratio, the price that investors are willing to pay for, and this is the S&P 500, so the broader stock market, the price investors are willing to pay for the stock market versus their earnings. Okay, and we know that over 2017, 2018, even into 2019 to a point. Stocks, the earnings didn't move that much. It was a good time for earnings, but not great. It was maybe 8% growth. So really what we saw here is because of those high interest rates, and especially, into 2019, as those interest rates were going up, we saw basically the same thing we're seeing right now. Is we saw, interest rates really pulling stocks down as the interest rates increased. But what we see here is, right here, so we got out of the pandemic right here, and then so that was pretty much the low of interest rates, and people started readjusting their valuations on stocks, and that just set off something that we've never seen in the history of the market. Really, is readjusting the valuation on stocks all the way up here. Okay, so here we've got 2018, late 2018, 2019. Stocks hit about 19 on a price to earnings basis, which is, right around that 10-year average. Pretty good price for stocks right there at 18 times. I would even say, right around this 2021, this green line, that 5-year average PE ratio for stocks, that's a pretty decent price, obviously, compared to where stocks are right now. But right now, just because interest rates are so low, and this is tied to a lot of the stimulus, a lot of the money flowing into the economy. That's all tied together really with interest rates and just pushing everything higher right now. So stocks right now are trading for about 32 times on a price to earnings basis. That's stocks in the S&P 500, and of course we know that stocks in the Nasdaq and some of those growth stocks are trading at much higher multiples. We'll actually look at Tesla. I think Tesla is something like 150 times earnings right now. And is actually has earnings. A lot of these stocks hardly even have any earnings to speak of. So they're at 500, 1,000 times earnings, things like that. So let's look at one more chart here of the interest rates, and this is a little bit longer term. So here we've got from 2000 all the way to current, and you can see, just how this has affected those PE ratios. What in 2001, 2002, after the dot-com bubble burst and we started getting back to normal a little bit, we used to talk about a PE ratio that was normal would be right around 15, right? That long-term average PE ratio for the market was right around 15 or 16. That was considered a fair value, for a price compared to the earnings of those companies in that index. And just over these last 5 years, 6 years, 10 years, really, as the interest rate has come down from normal about 5%, about 4% here, down to 0.5% last year, and really down 1% since 2012. It hit 1.5% in that year, and now we're talking about the fair value on stocks, price to earnings value of being 18, 19, 20, right? And this all goes back to how you value stocks, how you value your investments in the market with that discounted cash flow model. If interest rates are going to be extremely low, you're not discounting those future cash flows by quite as much. So the present value is worth more. You're willing to trade more of a price, or willing to pay more price for those earnings. Okay. And that's that's why that long-term price to earnings ratio has gone up over time. So, anytime somebody's saying, I'm waiting for the price to earnings ratio to be down to 15 till I buy, that's a fair value, a long-term estimate. It's not quite really the fair value that we're looking at in today's era of low rates. And while we do see rates going up over those last quite a few months, and I do believe they'll go higher throughout the year, they're not going to get back to 3, 4, 5% anytime soon. So I don't think you should be waiting till 15 times on a price to earnings basis to get back in stocks, because I think that would have to be oversold conditions, and I don't think we get back to those kinds of rates. Again, I want to emphasize that idea that your stocks are not the market. Okay, folks. I'm sorry. I know it's been painful for a lot of people out there, but I think a lot of new investors out there over the last year have come into the market and they're seeing these 100% annual returns in stocks. And again, following those high growth stocks up higher has been the winning trade. You've made 100% plus returns on those shares of Tesla, on those other shares of those high growth those tech stocks, and you think that's normal, but it's not normal. Okay, that is not normal, and you have to understand what happens when that momentum investment trade falls apart. And what we're going to do now is kind of look at that. What I've done in the past with that strategy is again, you really have to watch for that rotation into different stocks, that shift in the market mentality, in the economy, that is going to shift investors and the market into the different stocks. Something like what we talked about back in October, November of last year when we were doing the 2021 portfolio. We were looking at that and saying, okay, the pandemic isn't going to last forever. People aren't going to be locked down and investing in these high growth, or putting all their money in these high growth companies and things like that. People are going to have to get out. Interest rate, the economy is going to be booming with all this money pushed into it. Interest rates are going to go up, and so we started seeing that shift, that rotation into energy, into financials, into materials. That reflation trade that we talk about, and we dropped a lot of those high growth tech stocks that worked last year. Okay, that's really what you got to do if you're going to be using this momentum investing strategy. Okay, so now I want to shift kind of from what's going on, what's happening, and I do think it's going to continue to happen. We actually had a big relief rally on Friday. The 10-year Treasury stayed pretty well at their 1.55%. We got the Congress or the Senate passed their $1.9 trillion stimulus bill Friday. It'll go to the House. It'll go back and forth, but it's probably going to be on the president's desk by the end of this week to sign, which is going to mean more money flowing into the economy. That could be a relief rally for stocks, but it's a double-edged sword for investors. All that money going into the economy, the vaccines coming out, we're hitting about a little bit over 2 million people vaccinated or getting at least one shot every single day. We're reaching very close to that herd immunity idea, which I think by the end of March, we're going to have pretty close to herd immunity here in the United States and in other parts of the developed world, in Europe as well. And obviously, at that point, people start getting out. They start spending this money, this $2.5 trillion in additional household savings that they've saved up. And that's going to just be a boom in the economy, right? So what we're going to see is, even if we have a little bit of a relief rally right now in some of these hard hit sectors like the growth, the tech, and that kind of thing, those interest rates are going to keep on going up, folks. Okay, you cannot pump that much money into the economy, have that economic growth without having the inflation that comes with it, without having just generally higher interest rates. Okay, you can see, on that chart of long-term interest rates that we saw, it's even off of the lows of 0.5% last year, it's still only at 1.5%, which is pretty much the low that we've seen in the past 20 years. Okay, so it is not inconceivable that we could see rates back up to 2.5% by the end of this year, which would be a huge change again in that DCF formula, in that discounting of those future cash flows for these stocks. Again, you're no longer discounting those future cash flows on these fast growth, these future cash flow stocks by 1%, by 1.5%. Now you're discounting it by 2.5%, 3%. And that's a big change in the valuation, and I think it's gonna keep on going throughout this year. So you gotta understand that's what's gonna happen to these stocks all year long. Okay, so now I want to shift here from so what's happening into kind of how low can stocks go, where to set your price points on some of these, and find a fair value price for the indexes as well as some individual stocks. So first we'll talk about the indexes, right? The S&P 500 is very tech and discretionary heavy, consumer discretionary heavy, right? And so those are really two of the sectors, like we were talking about, two of the sectors that have really been hit hard by this reflation trade, by higher interest rates. So I think that's gonna hold the S&P 500 down more than say the Dow, right? The Dow Industrials Index or the Dow components, right? Those 30 stocks in that index, much older companies, slower growth, old school economic companies, right? So that's not falling as much, and that's what we're seeing in the markets now. Compared to the Nasdaq, though, the S&P is going to be a beauty. Okay, the tech heavy Nasdaq is just full of these high growth, fast growing tech companies, and it's just going to get hit all year round. What was really interesting with Friday is even though we saw that risk on rally, right? We call it, a lot of times you watch CNBC or Bloomberg and you'll hear them say it was a risk on day or it was a risk off day, right? Well, that's just obviously, the market sentiment, selling risky assets, selling risky sectors, and that's the risk off. Whereas the risk on is when everything looks better. Maybe we get some good economic news or good stimulus news, things like that, and it's a risk on rally where people shift their money into the riskier sectors, trying to make on that rebound. Well, what was really interesting Friday was that we had that risk on rally, but the tech heavy Nasdaq underperformed, right? And a lot of those risky sectors that we saw underperformed. And I think I've still got this up. We can look at that actually on so Friday. The S&P 500 was up 1.9%, 1.95%. I think the Nasdaq was up only 1.8%, 1.83%, something like that. So and then here you see technology underperformed 1.89%, consumer discretionary 0.64%. Okay, so what we saw was even though it was a risk on rally where investors were optimistic, the 10-year Treasury held steady, and maybe we get higher asset prices. They didn't quite go back to those risky sectors like they did with these other sectors, with energy, financials, industrials, materials, those reflation trades. So that's a real sign of conviction on this on this rotation, on this market shift, this rotation into those themes and into those sectors away from tech and that kind of thing. Is that even on the good days, those riskier sectors can't outperform. So what I want to do now is as we're thinking about what prices or how far stocks could come down, I want to look at kind of the PE ratios in those and what we think would be kind of fair PE ratios to target for these. And like I said, first we'll start with the indexes, and then we'll go on to individual stocks. So what we see here is that tech-heavy Nasdaq, right? The Nasdaq index is trading at a PE ratio, price-to-earnings ratio of 50 times trailing earnings. Okay, it's 50 times. The price of the Nasdaq is trading at 50 times the composite earnings of all the companies in that index, which is just ridiculous. Okay, and we've seen why that is, because interest rates are coming down so much that the cash flows from all those companies are collectively worth so much more now, because you're not discounting them at any kind of rate. Now, again, like we said, the PE ratios have been creeping up in this ultra low rate environment. But I'd say maybe a price to earnings ratio of 40 is probably a little bit closer to normal. And if you look at a chart of the PE ratio for the Nasdaq over time, then you can see that 40 was really, I mean, it's not even that low. I mean, perfectly, we would love to see something closer to maybe 30 or 35. But 30 would be, well, 40 would still be a little bit close to normal. It would get us down to something like mid last year, right? And but if we're looking at that, if stocks in the Nasdaq are trading at 50 times right now, and we're saying 40 is more normal, that's still a 20% potential downside. Okay, that would put us right around 10,000 on the index, on the Nasdaq, and actually back only to about February or June levels of last year. So it's not like we're even wiping out years of gains here. Okay. Now, I'm not sure it does get quite down to that level with all this stimulus and the pent-up demand that's coming into the economy, but I do believe that those interest rates are going to keep on rising, and it's going to really affect the valuation on those stocks and that PE ratio. So I think for the Nasdaq, for the tech stocks there in general, I'd be looking more at 11,000, 11,500 on the Nasdaq as a point where I start saying, okay, maybe the market isn't quite so overvalued right now with these interest rates coming up as they are. Maybe I want to start shifting a little bit more money into those tech stocks and things like that. And I'll share some other strategies and some specific strategies you can use. Now, again, the S&P 500, so those a little bit broader economy stocks as well as the Dow, probably much less to fall in this environment. Again, I don't think we're going to get a stock market crash this year. I just think it's the stock market doesn't crash when you get 5% economic growth, when you have $2.5 trillion in households spending coming online, when you have another $1.9 trillion that's about ready to be signed by the president and pushed into the economy. Stock prices don't fall, okay? It's just how it is, because you've got so much money pushing into corporate earnings that you're just not going to see it. The S&P 500 right now is trading at about 28 times on a price to earnings basis, and we can go back to that chart and see kind of where that is here, okay? And we can actually see, I've also got a chart from FactSet of the earnings expected by the stock market or by stock market analysts this year. So right now you see right here is current year 2021. Analysts polled by FactSet are expecting about $175 on earnings for the companies in the S&P 500 index, right? The aggregate earnings of all those companies in that index, about $175 this year. And so what we're looking at is the index traded for about 28 times that, or 28 times previous earnings right now. On a forward basis, it's a little bit less. So if we go, divided by 1, okay, it's traded at about 22 times, maybe a little bit less, about 21 times on that forward basis. So the earnings that are expected. And I would like to see it down to about 18 times on that forward basis, or about 23 times on the on the trailing basis. So if we did 18 times forward times 175, that brings us to about 3,200 on the S&P 500. Okay, and just to kind of show you where that would take us, that would be 20. Okay, so that's 18 times forward and 23. 3,200, 18, and if we take the forward earnings estimate for next year, analysts are expecting the stocks in the S&P 500 to clear $200 in earnings next year, $201.20. And if we say that 3,200 divided by 201.20, that puts us at about 16 times on a forward basis, which if we look back on this chart, okay, this is a trailing basis. So, and we're talking about 18 times by the end of this year, right? Which would put us right here on that 10-year average, okay? Which would actually be a really good price. I don't expect it'll get quite down to that point. It would take rates coming up very fast and very, very quickly for the S&P, I think, to get down to 18 times on a price to earnings basis. So I would probably say a little bit closer to be a buyer at 3,400 to 3,500, which is still be about another 10% discount from where we are, okay, and 13% from the peak, okay. Again, stocks in the S&P 500 are only down about 2.7%, about 3% from their peak. So I'm looking at stocks to come down at least probably about another 10% from here, hit that 13% down from the peak, which would be a correction. Before I start getting excited about buying in and valuations there. Now for the Dow, for its part, a lot of people don't talk quite as much about the Dow right now, but or anymore. But the Dow is trading at 23 times on a trailing basis. But these are those traditional slower growth stocks, so it's still not a value play, right? It's not necessarily value stocks here, because even compared to that Nasdaq, which is trading about 50 times on a price to earnings basis, they're growing at much faster earnings growth. For the Dow, I'd probably like to see it right around 20 times on a price to earnings basis, so closer to that 28,600, which would, again, that's only going to bring us back to like December, July levels of last year as far as those stock prices. So it's not like we're destroying a lot of wealth here by thinking that stocks are waiting for a lot of wealth destruction to come through before we start getting excited about these stocks. Now, can they fall further? Can stocks fall further? Well, yeah, hell yeah. You're never going to know the exact bottom where stocks are going to end up, But what you want to do, you want to use this kind of analysis, use this kind of price to earnings analysis, price to sales. Look at where things were when interest rates were a little bit higher. What I'm really doing here is looking at where this 10-year rate has been. Okay, so where it was in 2019, right around 2%. Maybe 2.5% right there in 2019, 2018. I don't think it's going to get up to 3%, but right around here, where were PE ratios then? And I didn't show you that, but I'll show you that here. Okay, so I'm looking at this, this longer term chart of the 10-year Treasury rate, or I can look at the shorter term chart, and I want to look at right here, right when stocks hit that 2% to 2.5%, where I think they're going to end up towards the end of this year. What was the PE ratio on the markets, okay? And where, so is that maybe a fairer value of where stocks are going to be? And what you want to do is you want to find that point where you think it's a fair value and where you're getting a discount on the stocks right now, and just be happy with that, okay? You got to set that idea of, okay, when am I going to be happy buying into stocks? When do I think stocks are a fair value? And set your strategy for that, and I'm going to share that with you right now. But otherwise, if you're just watching the markets every day, you're just stressing out, trying to chase the market down. If you've got no real plan for how much stocks should be worth, you're going to be sitting there going, okay, should I buy in now? Should I put some of this money to work? Or conversely, should I sell now? Are things going to get worse? And you're going to freaking tear your hair out every single day. With this kind of a strategy, though, you put a fair value on the market where you think stocks are fairly valued, and then with that, maybe you say, okay, so if I'm looking for a 3,200 value, or if I'm looking for S&P 500 to come down to maybe 3,400, 3,450, then if it gets down to that point, then maybe I put in 35% of my cash. So a third of my cash that I've got on the sidelines waiting for better prices, I put a third of that to work when the S&P 500 hits that point, right? I buy into my favorite stocks, in the market. Maybe when it goes that's gonna get you in the market. Okay, it's gonna free up or get rid of some of that excess cash, put it to work for you, but it's still gonna save a little bit behind, right? It's still gonna save a little bit back for for if stocks do come down further. You can also say, okay, so right now, I think stocks are expensive. I don't want to sell my stocks though, but I do think they could come down another 10%. Then maybe I want to sell some covered calls against some of my stocks, okay? That's going to give you the cash collected from those calls. It's going to hedge your downside a little bit, and you're not going to have to worry about that stock market sell-off, okay? You're not going to have to worry about stocks coming off 5 or 10% because you've got those covered calls that are hedging your position on some of those stocks. So this is just some of the ideas, some of the thinking that you need to do, so you're not stressing out on the market every single day, wondering how far things can go, okay? So now I want to talk about, so that's the indexes. That's kind of the general market idea of where I think the market can go and why. Basically I'm looking at 2019 when rates were still up there about 2% or so, what the PE ratio on the market was, and what that would mean for stocks right now, and then kind of applying that to the current stock market. Now I want to talk about individual stocks and what you can do. Now again though, if you're following these dream stocks, these stocks that have returned 100% plus over the last year, these growth stocks, these tech names, these dream stocks, you got to understand that momentum investing. You got to understand what happens when that dream becomes a nightmare, and just accept that. Okay, if you're going to, if you're not going to watch the stock market for the shifts, for the rotation into other stocks, and really shift your strategy, which is what true momentum investing has to be, is, you don't get married to one specific stock. You don't say Elon Musk is the best, the best thing since Jesus Christ. You say, okay, Elon Musk and Tesla stock has done really well in this environment, but I'm watching for the rotation so I can get into something else. So I get into energy or financials. That's momentum investing. If you don't want to do that, if you want to stick with Tesla stock forever, no matter what, that's fine. And that's, I think Tesla is going to be a great investment over the next 10 years, but you got to understand that and accept what happens when interest rates increase, and that growth and that momentum, that growth strategy, those tech stocks, fall out of favor. Okay, they're going to come down, and and it's going to hurt you. So you can either watch for those market rotations and switch your stocks, switch into different sectors, or you can just hold on longer term. You know, so what we're going to do here with these individual stocks and really trying to find price points on those, we're going to be looking at that 2019 when interest rates were higher, when the market was a little less expensive, looking at where that PE ratio for those stocks was then, and then applying it to the earnings now to see kind of what a fair value or a normalized idea of that price to earnings ratio would be. Okay, so and here I'm going to be using the Webull platform, which I love for this kind of stock research and analysis. They've got a lot of great tools here. Love using the paper portfolio on Webull. Gives you $1 million to invest in that stock simulator. Kind of test out your ideas, maybe track stocks, things like that. So it's something I've used for the last couple of years, and I really like the platform. Besides the fact that they give you 2 free shares just for depositing your money. So if you want, I'm going to leave a link to that in the video description below. Check out that link. Check out Webull and get your 2 free stocks if nothing else. So we're going to start with Tesla because I know a lot of you are going to have questions about Tesla and how far it can go down and when to buy in. Tesla right now is at $600 a share, which down from $900 is a pretty big hit. And this is what a lot of it's about 33%, right? Yeah, 33% from the peak there, and that's what a lot of you are looking at when you look at your portfolio and saying, Joe, how the hell is this not a stock market crash? My shares of Tesla are down 33% from the peak. How can that not be a stock market crash? But again, I'm sorry, folks, but your stocks are not the market. Okay, if you've got everything you had in Tesla, in some of these other high, NEO or CCIV or things like that, then that's momentum investing. That's growth stock investing, and you got to understand what happens when those come down. They come down fast. That momentum works in the other way. And I know, I've recommended a lot of these other stocks in the past. CCIV, that SPAC stock that we talked about, was one of them. We were in it at $10 about September, October of last year. I did my 3 SPAC companies that I would invest in. I invested in CCIV at $10, but if you were watching over these last 2 live streams over the last 2 weeks, I said, hey, you know what, you need to get out of a CCIV. I would be taking profits here at $50 and $60 a share. And now I think it's down to like $30 a share now. And it's a couple of different reasons with these SPACs, especially, and with CCIV, is that, you've got this growth and this momentum investing trend, or this change that happened with those higher PE or those higher interest rates, and just really hitting these high PE names, but also just the SPAC story, right? When they make that announcement of who they're going to acquire, then they tend to underperform. And that's not always the case. You've got things like DraftKings and things like that. But generally, those SPAC stocks, they do great until they make that announcement. And then they're going to underperform for a while until the company can prove that it's got the fundamentals to hold up that share price. So yeah, anyway, a lot of these, if you're in a lot of these high growth stocks, then you need to be watching for the change and need to be watching for that. So for Tesla in particular, just real quick, simple analysis you can do here. Generally when I want to invest in a stock, or when I want to analyze the fair intrinsic value of a stock, I'll do that discounted cash flows, or I'll do a little bit deeper analysis into the debt, the balance sheet. I want to look at the debt, how much debt and how much cash they have on the balance sheet. Make sure it's a stable company that has lots of financial flexibility. I'll look at the statement of cash flows. A lot of you, any of you in the Bowtie Nation there have been watching those cash flow or those financial statement analysis videos that we've done, and really the kind of analysis that we put into some of these stocks. But if you want to do just a real quick back of the envelope analysis on these stocks, then you can just go back here and look at 2019, 2018, when interest rates were a little bit more normal, right? 2%, 2.5% interest rates, that kind of thing. When stocks weren't bid up because of all this stimulus that's being pushed into the economy, being pushed into stocks. You got to understand. So January, households saved 20% of their discretionary income. Okay, that was the highest ever since since the statistics have been made since 1945, right? For that group, and so 20%, they're saving a fifth of their disposable income. And where do you think it's going? It's going into stocks. Okay, it's pushing stocks up because everybody's getting rich in stocks. So you really, if you want to find just a quick back of the envelope fair value on a lot of these stocks, you got to look at what was happening before before all that stuff, before interest rates were rock bottom, before all this stimulus was being pushed into stocks, and that's right around here, 2018, 2019. And we see here, I mean, Tesla was trading at about $65 a share back around that time. And we see, okay, so fiscal year 2019 really didn't make much of anything, 4 cents a share. But if we look at the fiscal year 2020, so right around 2019, investors are estimating the earnings for a company over the next year, saying, okay, how much do I want to pay for those forward earnings? So we've got $2.24 here. If we say normal would be, even here, even around the highs, around 88, we'll say $90 a share. So, and we were expecting 224 a share there. So 90 divided by 2.24. That gives us a price to earnings ratio, and here is on a forward basis, but a price to earnings ratio of about 40 times, which is it's pretty normal for a growth stock, for a tech stock, for a fast moving company like Tesla. It's pretty normal to have a price to earnings of 40 times. Obviously for some of those lower growth, those S&P 500 companies, the lower growth companies, you want to get closer to 15 to 20 to even, 22, 23, like we talked about. But for Tesla, 40 times on a price to earnings basis. But look at where it is now. Okay. Even considering we're expecting $4.12 in earnings for this year, for this fiscal 2021, it was trading at $900. So if we do that, 9 divided by, what was it, 415 we were expecting, right? Yeah, 412. It was trading at 216 times on a price to earnings basis. And again, of course, that was when the interest rates were super low still. Interest rates started the year at under 1%. They didn't look like they were going to rise ever. All the stimulus money was still being pushed into the economy. So that kind of justified prices at this point. But as we're talking about, as interest rates rise, that there is no way in hell it is worth 216 times on a price to earnings basis. So if we're looking at a more normal is around 40 times price to earnings, and we're looking at earnings of $4.12 over the next year, I mean, we're talking about closer to $164. Now, I don't think Tesla gets down to $164. That would put it, right around here, about February. That would put it before the pandemic sell-off, or right around here in April, last April's price. It can fall down to that point. I'm not saying it can't, but I don't think it does. I think Tesla at $165 would be a steal here. I would say probably closer to, I would be willing to pay maybe 50 or 60 times. So we'll go 55 times this year's expected earnings, be $226. Okay, which I know a lot of you Tesla investors aren't happy right now, and you're saying I'm full of shit and I don't know what I'm talking about. But I'm just saying, if investors were willing to pay only 40 times on a price to earnings basis back in 2019, on those earnings, then why are we paying 55 times, 60, 70, 80 times, 100 times earnings here in 2021 when, interest rates are increasing? So that's lowering the fair value of these shares because of that discounted cash flow formula. When we're having this growth, this rotation from those growth stocks into financials, into energy, into those other sectors. So the investor sentiment is coming out of these stocks. What you got to understand, when the shares of Tesla were trading at $900, it's because that's all investors were investing in. The entire market was saying, okay, Tesla is up 700% over the last year. It can do no wrong. It's never going to go down. Everyone was in that, investor sentiment was at an all-time high, right? Well, that's not the case anymore, obviously. 33% down from the high. Shares are now down to about $600 a share, and people are starting to question it. At least over the short term, investors are looking for other stocks to buy. Okay, so you got to start thinking, about what that does to the fair price to earnings ratio on the stock. And I would say, again, I would say down to maybe 226, 250 really at the most. Is where I would be looking at shares of Tesla at. Now, what you can do here is, again, if you've already got shares of Tesla, you're wondering what to do as far as buy or sell, or get out when you can or whatever. I wouldn't be selling. I mean, like I said, I think it's still a great long-term play here. What I would be doing is maybe selling some covered calls on it, short-term covered calls. So if the price does come down more, then you're protected a little bit on your downside. You can keep those shares and you collect that premium. If you're thinking about buying Tesla, conversely, then what you can do here, and what I've done a lot over this last week, picking up shares, is I've gone into the puts, right? I've sold the puts to other investors. I've collected that premium on those puts. This is called a cash secured put strategy, because I've got the cash to buy those shares if the shares come down further. But I collect that premium, and I collect that cash right now. So that's just a couple of the ways to do that. So that's kind of what I'm looking at on shares of Tesla. Let's do a couple other stocks here, just to kind of give you an idea of what we're talking about, and how to do this on your own. So shares of Apple, trading at $121 a share now, and actually, haven't come down quite nearly as much. Okay, so we'll look at the 1-year chart here. We see a high of about $142. If it's trading at about 120 now, that would be 1/7, right? Which is about 14%, right? So 120 divided by 140. So it's come down, 14%. So my math is still working. My old school math teachers will be happy that I knew the percentage on that. So it's down about 14%. Obviously, not nearly as bad as Tesla. It's not quite the growth stock, obviously, that Tesla is. It's not growing those earnings by quite as much. But you still see what's happened over the last 5 years here, as those interest rates fell. As the future cash flows of Apple started to be worth more in today's dollars with that discounted cash flow model, and as investor sentiment built, as all that stimulus money got pushed into stocks, pushed into the economy, I mean, the shares have just boomed. So here we've got 2018. Let's go to 2020 or 2019 here. Right around $55 $55 a share, right, for Apple. That's that's post adjusted basis. So I know they split here in last year, in about February, I think it was last year. So maybe not, maybe it's a little bit later. Anyway, about $55 a share was right around where Apple was trading at for most of, you've got 2018, 2019, right around then. More of a normalized area within terms of interest rates, as well as that stimulus money and the economic growth and all that. So if we had $55 in that, we'll go here to financials, and it's going to show us all these earnings per share, forecasted and past. And if we had about $3, we had about $3 in earnings per share at that time. So we'll say 55 divided by the 3. That gives us 55 times 3. That kind of worried me there. 55 times 3. No, that's actually, that was correct. $55 share price divided by 3 is 18 times. So 18 times earnings on a price to earnings basis. Okay, so we're looking at a more normal time for Apple. It's trading at about 18 times on a price to earnings basis. Okay, and actually, Apple has traded at 10 times on a price to earnings basis many times in the past. A lot of times. So just back here in 2016. It had $2.30 a share in earnings. That was just before the refresh cycle on the iPhone. And what happens a lot with Apple is, that older version of the iPhone gets old. They haven't quite refreshed it into the new phones yet, and so the stock shares, the shares suffer. Okay, the quarterly earnings aren't so great. The sales aren't so great because people are waiting for that new version of the iPhone to come out. So we've got back here in 2016 where it was trading at 10 times on a price to earnings basis. Now that they're refreshing the iPhone cycle more frequently, then I don't think it'll ever get down to 10 times price to earnings again. But we see here, a more normalized area was right around that 18, maybe even, if we call it 60 here, which was towards the end of 2019. that would still be about 20 times price to earnings basis. Okay, so we're saying 20 times on price to earnings basis is a little bit closer to fair for Apple. But now let's look at where it was. 140 times, and it was, we were expecting $4, but we only had about 328. So we'll cut the difference there. Say 140 divided by maybe 350. It was trading at 40 times on a price to earnings basis. Okay, so right at that kind of trailing forward basis idea. So that's basically double what we're saying is a more normalized area. That's the effect that interest rates and the stimulus money have had on shares of Apple. Okay, going from trading for 20 times on a price to earnings basis to trading at 40 times on a price to earnings basis. So, of course, like we're saying, what happens when all the stimulus comes out of the economy, when that's no longer being pumped in? What happens when interest rates rise back up to 2.5%? Does that mean that Apple shares come back to 20 times earnings? And what does that mean for the price? So if we're saying 20 times earnings for Apple, and we're saying they're expecting about $4.50 a share over this next year, 4.5 times 20, that's $90. So $90 a share for Apple is kind of our base case. I mean, I would like to pick up shares of Apple at $90 each. I don't know that they're going to get down that far. I mean, that would still be, that would be 30, that would be a 25% fall from here, which I don't think shares of Apple make it down that far. I would be closer to maybe $105, which, I mean, and we can do the math there. 105 divided by 4.5, that would still be 23 times, which, wouldn't get us down to that 20 times multiple, that 20 times price to earnings ratio, but it'd still be a hell of a lot closer than 40 or a hell of a lot closer than 30. Okay. Right now, I think it's trading at around 30 times price to earnings. If we go 120 divided by 4.5, that's 27 times. Okay, so getting it down to 23 would be right about the time when I would start looking at Apple, and saying, okay, maybe now I invest a third of the money that I was going to invest in Apple. Okay, and I hold the rest of my money for when it does come down to $190 a share and more fair value. Okay. Because again, with all this money being pumped into the system, I mean, especially with Apple, something like a consumer products company like Apple, where people are buying that, people are going to be spending this $2.5 trillion of excess household savings on stuff like that. I think Apple is going to do very well, into mid-year and beyond, even if interest rates start increasing. Okay, so what we're talking about here is interest rates are going to keep on increasing, and that's going to bring down the fair price to earnings value of the stock, but the earnings are going to go higher. Okay, I think Apple easily beats this $4.50 expected, and you can see it, and they always beat earnings expectations. But I think this year, with all that money being pumped into the system, especially by consumers, by households, I think they easily beat this $4.45 expected. Maybe even upwards of like 10% higher. So maybe Apple reports $5 a share in earnings this year. Which again, if we're looking at $5 a share, if we're looking at that fair value price to earnings ratio of 20 times, that gets them to $100 a share. So I would be very comfortable here with Apple at $105 as I'm building my position. I want to do a couple more here, and then we'll hit to questions. Cover a few of the other high growth tech stocks here. Two of them, one of them that I really like here at PayPal. If you watched the digital wallets video we did a couple of weeks ago, one of my favorite themes with some ARK Invest research there, digital wallets could be worth $20,000 each customer, and PayPal is the undeniable leader in that space. And so, I think this could be a $1 trillion company over the next 5 years or so. But right now, we're talking about this same thing with this very high PE ratio, these growth stocks theme that are losing favor. If we look at the 5-year chart here, $240 right now, but it was up at $300. So we go to financials here to see what the earnings are, and I got to check because that looked very similar to what Apple was. But okay, so $300. They posted $3.88 a share last fiscal year. They're expected $4.56 this fiscal year. So if we just take on a trailing basis, 300 divided by that 388, they were trading as high as $77 on a price to earnings basis, right? And so if we go back here to what we said was more normal, a normalized area or time when the interest rates weren't rock bottom, when that stimulus money wasn't coming into the economy, we're looking at it right around $115 a share, right? That's between May of 2019 all the way through towards the end of 2019. It was he was trading right around $115 a share. And if we look, here that would have been on a trailing basis on that about $3.10 a share. 115 divided by 310, that would have been $37 or 37 times on that price to earnings basis. Still high, kind of like Tesla. It's still going to be a growth stock, very very much fast earnings growth. So investors are paying more for these shares than something like Apple. But it's definitely not 70 times. 70 times. So basically, the price to earnings ratio has basically doubled over the last year just because of the interest rates, just because of all the stimulus money. So if we're talking about a more normal price to earnings ratio of PayPal around $37 a share, and we're expecting $4.56 a share this year, 456 times 37 is about 168, 170, 170 bucks, and it's right now at $240. So again, like we saw with Apple, like we saw with Tesla, I am just not there yet where I'm comfortable buying these shares because they're nowhere near what a more normalized price to earnings ratio would be. If we're saying $170 for PayPal, that would take us back to July, August prices, before the stock market really started booming, before some of this craziness really set in. But it would still be, $30, $70 below what it is now. Quite a big move. I think I would probably be closer to maybe about $200 on PayPal. So if it gets down to $200, which would still be another $40 downside on that price, I would be closer to like we're talking about. Put maybe half of the money that I want to invest in PayPal, put half of that to that stock at $200 a share, and see if it comes down a little bit more to take advantage of the lower downside on that. But I do like the stock over the long term, and I want to get in on it at that point. So just a real quick and easy way to find a price point that you like for stocks, to kind of get an idea of how low you think stocks could go. And again, it's not to call the exact bottom of the stocks. Like I said, I like shares of PayPal at $170, at $200. That doesn't mean that they can't go even lower. They can't go to 150 or even like what we saw, in 2000. Up to down to 100. If things really hit the fan and things got bad, shares of PayPal could go down to 150 or $100 a share. But what I'm saying is that with the earnings as they are, with my outlook on distant cash flows from PayPal and that idea of digital wallets, and a normal era PE ratio, I would be just fine paying $200, $170 a share, getting into those shares over the long term, because eventually we're going to get another stock market boom, and shares are going to go back up past that 37 times on a price to earnings basis. The earnings are going to explode over the next 5 or 10 years. And I would be very happy with that return that I got on that $170, $200 price range, even if in the short term shares did come down. Okay. What I'm saying is this, this kind of a strategy, this kind of an idea, getting an idea of how much you want to pay for a stock and holding out for that. Not stressing out every day on, oh my God, are the shares going to meet my price point, or are they going to boom higher or whatever? Just sticking with your strategy, it's a much less stressful way to invest. You're not stressing out every day, sitting there watching the market go up and down, wondering how far they can go down, when you should invest, why you should invest, things like that. Pick your stocks, find a fair value price to earnings ratio that you can be happy with, you can be comfortable with, and then invest, and set your price point and invest when they get there. Set a price alert on your trading platform, whether it's Webull or E-Trade or wherever you make your investments. Set that alert so that the platform tells you when the stocks hit that range, and just don't worry about it. Do what you do best. Make money how you make money, and and don't worry about where stocks are going on a day-to-day basis. So I want to turn this over to question and answer, and I realize this